The RBI dividend is the amount of money that the Reserve Bank of India, RBI, pays to the central government every year from its surplus income. The surplus income is the difference between the RBI's total income and its total expenditure. The RBI's income mainly comes from the interest it earns on its domestic and foreign assets, such as government securities, treasury bills, foreign exchange reserves, etc. The RBI's expenditure mainly includes the cost of printing currency notes, staff salaries, operational expenses, etc. The RBI dividend is calculated based on the accounting year of the RBI, which runs from July to June. The RBI follows a contingency risk buffer framework, which determines how much of its surplus income it can transfer to the government and how much it has to retain as reserves. The framework specifies a range of 5.5% to 6.5% of the RBI's balance sheet size as the optimal level of reserves. If the reserves are below this range, the RBI transfers less dividend to the government and keeps more for itself. If the reserves are above this range, the RBI transfers more dividend to the government and keeps less for itself. The Reserve Bank of India, RBI, is the central bank of the country, and one of its functions is to pay dividends to the government from its surplus income. The RBI's surplus income mainly comes from the interest it earns on its holdings of government securities, foreign exchange reserves, and other assets. The RBI also incurs expenses on its operations, such as printing currency notes, maintaining reserves, and paying salaries. For the financial year 2021 to 22, FY22, the RBI has approved a dividend payment of 30,307 rupees crore to the government. This is much lower than the 99,122 rupees crore that the RBI paid for the previous 9-month period, July 2020 to March 2021. The reason for this decline is not clear, but some possible factors are: the RBI had to make higher provisions for contingencies and risks, such as exchange rate fluctuations, market volatility, and inflationary pressures. The RBI decided to maintain its contingency risk buffer at 5.5%, in line with the recommendations of the Bimal-Jalan Committee report. The RBI had lower interest income from its liquidity management operations, as it had to inject more funds into the banking system to support the economic recovery amid the COVID-19 pandemic. The RBI also reduced its policy rates and kept them at record low levels, which lowered its returns on lending to banks. The RBI had lower gains from its foreign exchange transactions, as it had to intervene in the currency market to prevent excessive appreciation of the rupee. The rupee appreciated by about 3% against the US dollar in FY22, which reduced the value of the RBI's foreign exchange reserves in rupee terms. The decline in RBI dividend for FY22 has a significant impact on the government's fiscal deficit, which is the difference between its revenue and expenditure. The government had estimated a dividend receipt of 73,948 rupees crore from the RBI and public sector banks and financial institutions in FY23. However, with the RBI paying only 30,307 rupees crore, there is a shortfall of 43,641 rupees crore. This means that the government will have to either borrow more from the market or cut down its spending or increase its revenue from other sources to meet its fiscal deficit target of 6.8% of GDP for FY23. The RBI dividend is an important source of non-tax revenue for the government and helps it finance its various schemes and programs. However, it is also subject to uncertainties and fluctuations depending on the RBI's income and expenditure. Therefore, it is advisable for the government to not rely too much on the RBI dividend and focus more on improving its tax collection and asset monetization efforts to achieve fiscal consolidation and sustainability. The RBI dividend decision is one of the key factors that can affect the macroeconomic environment and the financial markets in India. In this section, we will analyze the implications of RBI dividend for investors in terms of interest rates, inflation, bond yields, and stock markets. Interest rates. The RBI dividend is a source of non-tax revenue for the government, which can help reduce the fiscal deficit and the borrowing requirement. A lower fiscal deficit can ease the pressure on interest rates and create more space for monetary policy easing. This can benefit investors who are looking for lower borrowing costs and higher returns on fixed income instruments. However, if the RBI dividend is higher than expected, it can also raise concerns about the central bank's balance sheet strength and its ability to manage liquidity and inflation in the future. This can lead to higher interest rate expectations and lower bond prices. Inflation. The RBI dividend can also have an impact on inflation through two channels. First, a higher dividend can increase the money supply in the economy, which can fuel inflationary pressures if not sterilized by the RBI. Second, a higher dividend can boost government spending, which can stimulate aggregate demand and push up prices. Therefore, investors need to monitor the inflation outlook and the RBI's policy stance to gauge the impact of dividend on their real returns. Bond yields. The bond market is sensitive to the RBI dividend decision as it affects the supply and demand dynamics of government securities. A higher dividend can reduce the supply of bonds in the market, which can support bond prices and lower yields. Conversely, a lower dividend can increase the supply of bonds in the market, which can put downward pressure on bond prices and raise yields. Therefore, investors need to factor in the RBI dividend along with other factors such as fiscal policy, monetary policy, inflation expectations, and global cues when investing in bonds. Stock markets. The stock market can react positively or negatively to the RBI dividend decision depending on how it affects the overall economic outlook and corporate earnings. A higher dividend can boost market sentiment by improving the fiscal situation and reducing interest rates. This can benefit sectors such as infrastructure, real estate, banking, and finance, which are dependent on government spending and credit growth. However, a higher dividend can also hurt market sentiment by raising inflation risks and compromising the RBI's autonomy and credibility. This can adversely affect sectors such as consumer goods, automobiles, metals, and energy, which are sensitive to inflation and interest rates.